US retail sales are sluggish and dragging on first quarter US GDP growth. China's economy outperformed expectations in February, so ANZ Research has lifted its GDP growth forecast for this year and next year. And New Zealand's housing market is stirring, but slowly. That's coming up in our 5 Things in 5 Minutes on Tuesday, March the 18th. And then, in today's bonus deep dive interview, ANZ China strategist Zhaopeng Xing analyses China's fiscal response to soften the economic impact of US tariffs, given every 10 percentage points of tariffs hits China's GDP by half a percentage point.
So far, the US only added 20% of additional tariff on China imports. So I think the fiscal measures should be sufficient for the uncertainty in the rest of the year.
But first, in 5 and 5 with ANZ, US retail sales data for February overnight was sluggish as consumers there get nervous about the economic and trade turmoil around President Donald Trump. Here's ANZ economist Bansi Madhavani on the 1% rise in underlying retail sales, which offset a fall of the same amount last month.
But apart from that, discretionary spending is pretty weak. So when you put that together, what we're seeing is that in the first 2 months of the year, retail consumption has largely stayed stagnant and consumers are not splurging on discretionary items. What that tells us is that growth is likely to slow this quarter.
As of 4 a.m. Sydney Melbourne time, the US dollar index was down 0.3%. The Aussie dollar was up 1% at 63.86 US cents. The Kiwi up 1.3% at 58.20 US cents. Gold up 0.2% and over that $3,000 an ounce mark at $3,005.80. Oil was also up. The S&P 500 up 0.6% and the US 10-year bond yield down 3 basis points at 4.28%. Number 2, ANZ Research has revised up its growth forecast for China overnight after stronger than expected industrial production and retail sales data for February. ANZ's chief economist for Greater China, Raymond Yung, now sees 4.8% GDP growth this year, up from 4.3% previously. He also revised up his GDP forecast for 2026 by half a percentage point to 4.5%.
Despite less working days in the first 2 months, we had seen a very strong industrial production, 5.9% for the first 2 months, it's close to 6%. It's well exceeded our forecast of 5.2%. And also retail sales, we bought 4% increase. Fixed asset investment, 4.1% increase in nominal term. And considering the fact that China has a negative deflator, so the real growth of both retail sales and investment seems to be higher than the headline growth and might well be close to 5% too.
Number 3. Also in China, the government released its special action plan for boosting consumption yesterday. Here's Raymond again.
We expect that the government will continue to focus on employment supportive policy, and the authorities also launch a grand plan of consumption boosting measures, including 30 items. It's a big plan. Now, what strikes us is that the government explicitly said that they are going to support the stock market. And this tells us that they now understand the critical role of asset price reflation is a better way to combat the balance sheet recession. And this is a quickest way to boost household consumption. By lifting their confidence level, then we'll be able to see a better consumption outlook for China in 2025.
Number 4. Meanwhile, New Zealand's services sector is still struggling to rebound. The Business NZ BNZ PSI survey found a return to contractionary territory in February. ANZ senior economist Miles Workman says this monthly leading indicator can be volatile.
The big picture, if I look through where this data is actually trending, you can still certainly see a recovery is underway. Things are picking up from a weak base. It's just that the here and now demand and the activity in the economy is not super strong right now, but it is on an improving path still.
Number 5. New Zealand house price data for February was released yesterday and showed a seasonally adjusted 0.4% rise in prices, which Miles says is consistent with a forecast for a 6% rise in prices this year.
The big picture story is that we are still seeing the supply side moving alongside demand. So we've got lower interest rates, that's feeding through to demand for houses, but there's still a decent increase in new listings, which is basically meaning that total inventories are notching higher and they are actually near a decade level elevation at the moment, which is providing some offset to price pressures. So if you think about more people out there wanting to buy a house, more more people meeting that demand with the supply of houses, that just provides less space for prices to rise, meaning that those price pressures are for now constrained. Fast forward 6 months from now, we think we should see a bit of that momentum through that price channel begin to build and a bit more of an acceleration on the house price side.
Miles Workman there. Now, in today's bonus deep dive interview, ANZ China strategist Zhaopeng Xing spoke to my colleague Alex Tarrant about China's fiscal response and how it softens the economic impact of US tariffs.
For the full picture of the government budget, I think we need to cover both the general public budget and also the government funds budget. The gap between expenditure and revenue in these two budgets rise by 3.5 trillion, equal to 2.2% of GDP. I think this is a significant rise compared with last year.
And how far do you think that this would go towards reducing the impact of US tariffs on China?
Basically, 2.2% of GDP. I think the impact brought by the US tariff is 0.5% of GDP for every 10% increase in US tariff. So 2.2% of GDP will be sufficient to offset 40% of US tariff. So far, the US only added 20% of additional tariff on China imports. So I think the fiscal measures should be sufficient for the uncertainty in the rest of the year.
And how does China's fiscal plan for 2025 sit against expectations before it was announced?
A market consensus was that maybe 2 trillion RMB increase in the deficit, but currently we got 3.5 trillion. That's much larger than the market consensus. But what's disappointing is the special treasury bond issuance. The upper bound of market expectation was 3 trillion, but finally we only got 1.8 trillion. So this is a little bit disappointing. But overall, I think the fiscal measures should be proactive and strong.
You say it's a record deficit, or would be a record deficit if it comes to fruition. Is there scope for them to increase it even further if they need to respond again to further tariff announcements or a global downturn?
China was almost 8.5% of GDP in 2020. That was the highest before. This year, we got the deficit to GDP ratio rising to 9.9%. So this will be the highest in the history. I think compared with the fiscal difficulty during the pandemic, 2025, certainly the challenge will be similar. So the government will have to raise more funds for the future uncertainty. Going forward, we expect with the economic rebounds and the improvement in both sentiment and also the economic data, we expect China to keep the fiscal deficit ratio stable at about 10% in the next few years. Anyway, the fiscal measures I think should be the most effective policy measure against the current economic cycle.
Zhaopeng Xing there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, March the 18th. Catch you tomorrow with detail on what the Euro's doing. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.